Professional trading isn't a game of constant action. It's a business of calculated patience. The amateur believes that money is made by being in the market at all times, chasing every minor fluctuation. The professional, however, knows that the greatest profits come from waiting quietly for the rare, high-probability opportunities to present themselves. This is the core philosophy of William Delbert Gann. His entire methodology was designed to filter out the market's noise and identify those specific moments when multiple independent signals align to point toward a single, undeniable conclusion. This confluence of evidence is what he called a definite indication, or what we will define as a high probability setup. This is not about finding a single magic indicator. It's about building a case piece by piece until the market's own testimony becomes irrefutable. In this guide, we will dissect the 5 essential elements that constitute a high-probability setup according to the timeless techniques of William Delbert Gann. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. Every high-probability trade begins with an understanding of the big picture. Before even considering an entry, a professional trader must first answer the most fundamental question: what is the primary trend? To trade against the market's main underlying current is to engage in a low-probability gamble. William Delbert Gann's primary tools for determining this were his long-term monthly and weekly high-low charts. He understood that the story of a stock's major campaigns, its great bull markets and devastating bear markets, is written on these long-term charts. The construction of these charts is a study in simplicity. For each month or week, a single vertical line is drawn from the highest price reached during that period to the lowest price. The purpose of this long-term view is to filter out the deceptive daily noise and reveal the market's true structural formation. A pattern of progressively higher monthly bottoms and higher monthly tops, unfolding over many months or even years, is the unmistakable signature of a primary bull market. A high-probability buy setup can only exist in this type of environment. Conversely, a series of lower monthly tops and lower monthly bottoms signals a primary bear market where only short-selling setups should be considered. These long-term charts are also the definitive guide for identifying the great zones of accumulation and distribution. William Delbert Gann taught that major market moves require a long period of preparation. After a long decline, a stock will enter a phase of accumulation, where informed interests quietly absorb shares from a discouraged public. On a monthly chart, this appears as a prolonged sideways base, where the stock stops making new lows and trades within a defined range. For example, he noted that U.S. Steel, after its initial public offering, declined to a low of $885 in 1904. It then remained in a narrow range between 9 and 10 for many months. This was the period of accumulation that laid the foundation for its long advance. A high-probability setup rarely occurs in the middle of a fast decline. It begins to form when the market demonstrates, over a period of many weeks or months, that it is building a cause for a new move. The weekly and monthly charts are the only tools that can make this large-scale preparation visible. A trader must first use these charts to confirm that the primary trend is in his favor, and that the market has completed a clear period of preparation before he can even begin to look for a specific entry. Once the primary market structure is understood, the next step is to identify the precise price zones where a turn is most likely to occur. These are the historical and mathematical battlegrounds where the forces of supply and demand are expected to collide. A setup's probability of success increases dramatically when it forms at one of these pre-calculated levels. The first and most fundamental of these are the old tops and bottoms. The market has a memory, and past levels where major reversals occurred remain potent for years to come. William Delbert Gann established a primary rule. Tops or ceilings which are selling points become floors, supports or buying points after these tops have been crossed. Conversely, old bottoms once broken become new resistance levels. For instance, in Truth of the Stock tape, he analyzed American Can. The stock had a low of 20 in 1914. It then rallied to 68 in 1915 and again in 1916, forming a major double top. This old high at 68 then became a critical resistance level for years. When the stock finally broke through 68 in the fall of 1922, it was a major signal that a new bull campaign was underway, which was an indication for higher prices and you should buy more. A high-probability buy setup often occurs as a throwback to a major old high that has just been broken. Similarly, a high-probability short-selling setup appears when a stock rallies back to a major old low that has been violated. While old tops and bottoms provide the market's visible structure, William Delbert Gann's deeper work revealed a hidden mathematical architecture based on percentages. He considered this one of his greatest discoveries. He found that market movements are not random but are harmonically related by precise percentage divisions of their major ranges and all-time high or low prices. A setup's probability is magnified exponentially when it occurs at one of these key mathematical points. The most important of all these divisions is the 50% level. William Delbert Gann stated, "The most important resistance level is 50% of any high or low price." This halfway point acts as the market's natural center of gravity. A decline of 50% from a major high represents a critical support zone. A rally that recovers 50% of the previous decline will meet powerful resistance. He provided numerous historical examples to prove this rule. The most dramatic was the 1929 panic. The all-time high was 386.10 on September 3, 1929. The 50% level of this price is 193.05. The fastest decline in history followed, culminating in the first panic bottom on November 13, 1929, at a low of 195.35, holding just over 2 points above this critical 50% support level before staging a 100-point rally. Another powerful example is the 1937 bull market top. The advance that began from the 1932 low culminated on March 8, 1937, at a high of 195.50. This was a direct hit of the same 1930 resistance zone derived from the 1929 high. This demonstrated how a major price level can remain a dominant force in the market for years. A setup to sell short in early 1937 became a high-probability opportunity precisely because it was occurring at this pre-calculated 50% resistance zone. The next most important levels are the quarter points, 25% and 75%, and the thirds, 33 1/3% and 66 2/3%. A 25% decline from a final high is often the first major support zone in a new bear market and a place to watch for a significant rally. For example, the final high of the post-war bull market was 213.36 on May 29, 1946. A 25% decline from this price calculates to 160.02. The market subsequently made major bottoms at 160.49 in October 1946, 161.32 in May 1947, and 160.62 in June 1949, holding this 25% support level 3 times over a period of 3 years. A buy setup at this level in 1949 was a high probability trade because it was occurring at a proven long-term support zone. A high probability setup, therefore, begins to take shape when the trader identifies a confluence between the market's foundational structure and its mathematical architecture. He uses his long-term charts to determine the primary trend and identify the major zones of preparation. Then he calculates the key percentage levels based on the major historical highs, lows, and ranges. When the market approaches one of these critical price levels in harmony with the primary trend, the conditions for a high probability opportunity are beginning to align. The trader now knows where to look. The next step is to wait for the market to provide the confirming signals that the level is ready to hold. Having identified the market's architectural framework, the foundational and mathematical price levels where significant turns are most likely to occur, The professional trader now enters a state of patient observation. He knows where to look. The next and most critical question is when to act. A price level, no matter how powerful, is merely a location. It is not in itself a command to buy or sell. To act simply because a stock has reached a 50% retracement point is to engage in prediction, a form of guesswork. The methodology of William Delbert Gann is not based on prediction. It is based on confirmation. He taught that a trader must wait for the market itself to provide a clear, definite, and mechanical signal that the level has held and a new trend has begun. This is the trigger. It is the evidence that transforms a potential setup into an actionable, high-probability opportunity. The triggers that William Delbert Gann waited for were not subjective patterns or complex indicators. They were precise, rule-based reversals on his unique swing charts. These charts were his ultimate tool for filtering out the market's meaningless noise and identifying the exact moment the balance of power between buyers and sellers had shifted. The first and most immediate of these triggers is a reversal on the 3-day swing chart. This chart is designed to define the minor or immediate trend. Its rules are purely mechanical, removing all emotion and judgment. The trend is not considered to have reversed from down to up until the market has had 3 consecutive days, with both a higher high and a higher low. Furthermore, to confirm this turn, the price must then cross the top of the last minor swing down. This is the initial actionable signal. Let's construct a scenario for a high-probability buy setup. A stock has been in a primary bull market, as confirmed by its monthly and weekly charts. It then enters a normal correction, declining for several weeks. The trader has pre-calculated a major support zone at $100, which represents both an old top and a 50% retracement of the last major advance. The stock declines and hits $100. The trader does nothing. He waits. The stock rallies for a day, then falls back for 2. Still, he waits. The 3-day swing chart trend is still definitively down. Then the stock puts in a day with a higher high and a higher low. This is the first sign of life. It does so again on the 2nd day and again on the 3rd. At the close of this 3rd day, the 3-day swing chart has mechanically reversed its trend to up. This is the first part of the signal. The final trigger comes when the subsequent advance crosses the top of the last minor 3-day swing down. At that moment, the setup is active. The trader has received his definite indication. The major price level has held, and the immediate trend has confirmed the turn. He can now enter a long position, placing his protective stop-loss order just below the $100 support level. While the 3-day swing chart provides the initial entry signal, William Delbert Gann used a more powerful filter to confirm that a new intermediate or major trend was underway, the 9-point swing chart. This chart is designed to ignore all minor reactions and keep the trader focused solely on the significant profitable moves. Its rule is based on a fixed price reversal. The trend does not reverse from down to up until the market has rallied 9 full points from its last extreme low. A reversal on this chart is a far more significant event than one on the 3-day chart. It confirms that the buying power is not just causing a minor bounce, but is strong enough to initiate a sustainable advance. This signal provides the high probability opportunity to add to a position or pyramid. Continuing our example, the trader has entered a long position at $104 after the 3-day swing chart confirmed the reversal from the $100 support level. The stock continues to advance. It rallies 5 points, then reacts 3 points. The 9-point swing chart remains down. Then, the advance resumes with force. The stock rallies to $109.50, which is now more than 9 full points above the extreme low of $100. At this moment, the 9-point swing chart mechanically reverses its trend to up. This is the major confirmation. It signals that the intermediate trend has aligned with the primary bull market. The trader now has a high probability signal to add to his initial position, confident that he is trading in harmony with both the minor and the major trend. with his stop-loss orders protecting his entire position. A high-probability setup is a confluence of evidence. While the charts provide the mechanical triggers, volume provides the confirmation of force. William Delbert Gann taught that volume is the effort that produces the result of price movement. He stated, "The volume of sales to the stock market is the same as the steam is to the locomotive or the gasoline is to the automobile. A chart signal that is not supported by a logical volume signature is suspect." When waiting for a buy setup at a major support level, there are two key volume signatures that confirm the level will hold. The first is a test of support on diminishing volume. For example, after a high-volume selling climax establishes the initial low at a support zone, a subsequent decline to retest that low must occur on drastically lower volume. This proves that the selling pressure has been exhausted. It's a sign that the supply has dried up, one of the most bullish indications a trader can see. A 3-day swing chart reversal that occurs after a low-volume test is an exceptionally high-probability buy signal. The second sign of strength is a breakout on increasing volume. When the swing chart gives a buy signal by crossing an old swing top, the volume must expand. This surge in volume is the effort that proves the buyers are aggressive and have the power to overcome resistance. It confirms the validity of the breakout. The same principles apply in reverse for a short-selling setup at a resistance level. A buying climax on extreme volume at a major Gann level, where a massive amount of effort fails to produce any significant further upward price movement, is a major sign of distribution. A subsequent reversal to the downside on the swing chart is a high-probability sell signal. Another powerful sign of weakness is a weak rally on low volume. If a stock rallies back to a major resistance level, but the volume on the rally is weak and diminishing, it shows that the buyers lack conviction. The effort is absent. When the swing chart then gives a sell signal by breaking a swing bottom, it confirms that the weak demand has failed and the sellers are retaking control. To truly master the art of reading these confirmation signals at critical market junctures, to interpret the subtle interplay of price and volume that confirms whether a level will hold or break, one must go to the source. The rules and principles we are discussing are but an introduction to the deep and practical science laid out by William Delbert Gann in his foundational masterpiece, Truth of the Stock Tape. This isn't just a book. It's a complete course in reading the tape as he did, to understand the story it tells about the constant battle between buyers and sellers, between the informed insiders and the hopeful public. It is the definitive guide to judging the position of stocks, identifying accumulation and distribution, and determining the main trend by analyzing the force behind the moves. In preparing this analysis for you, we have gone to great lengths to uncover the original materials. We were able to locate in archives over a century old the very charts that William Delbert Gann himself included in the first edition of Truth of the Stock Tape. We must be honest about their condition. Not all have survived the passage of time in perfect form. Some are remarkably clear, while others are more difficult to read. We ask that you do not judge them too harshly for their appearance. What could be done to preserve them has been done. Their value is not in their visual perfection, but in their immense historical and educational worth. They are a direct window into the mind of a master, showing you exactly what he was looking at when he formulated his timeless rules. The true value lies in the material itself. For any serious student who wishes to move beyond simply drawing lines and truly learn to read the market's intent, this book is indispensable. Get your copy of this invaluable resource through the link in the description below. We have now assembled the primary building blocks of a high-probability setup according to the methodology of William Delbert Gann. We understand the necessity of a sound market structure. We know how to identify the critical price levels where battles will be fought. We have the mechanical chart triggers to signal a turn, and we know how to use volume to confirm the force behind a move. Each of these elements provides a crucial layer of evidence. But there is one final master element that elevates a good setup into a great one. It is the factor that William Delbert Gann considered the most powerful and important of all. Time. The time factor is the ultimate confirmation. A setup's probability of success increases dramatically when its formation aligns with a pre-calculated, significant time cycle. William Delbert Gann believed that the market, like the universe itself, is governed by cyclical laws. Trends do not begin or end randomly. They do so according to a schedule. By understanding this schedule, a trader can anticipate when a major turn is most likely to occur, allowing him to pay the closest attention at the most opportune moments. The first layer of time analysis is the study of seasonal and yearly cycles. Through decades of research, William Delbert Gann discovered that certain months of the year had a statistically high probability of producing major tops and bottoms. He found that the greatest number of major bull market tops occurred in September. Therefore, if a market has been in a prolonged advance and is approaching a major price resistance level during the month of September, the setup carries significantly more weight. Conversely, his record showed that the greatest number of bear market bottoms occurred in November, with July being the second most frequent month for major lows. A buy setup that forms at a major support level during one of these months is a higher probability opportunity. This seasonal calendar provides a temporal roadmap, alerting the trader to the times of year when the market is most predisposed to a major change in character. The most powerful time-based confirmation, however, comes from what William Delbert Gann called anniversary dates. He discovered that the market has a long-term memory and will often experience a major turn on or near the anniversary of a past major high or low. The most important of these are the 1, 2, 3, 5, and 7-year anniversaries. A setup that forms on or near a major anniversary date is the ultimate confluence of events. Imagine a scenario where a stock is approaching its 50% price level 2 years, a 24-month cycle, after making a major bottom. The trader would be on high alert. If upon reaching that price level within that time window the swing charts confirm a reversal, the setup is of the highest quality. This alignment of price and time, confirmed by the chart, is the signature of a truly high probability trade. Now let us bring all 5 elements together to walk through a complete, historically based example of an A-grade, high probability setup. We will use the major market bottom of June 1949 as our case study. A professional trader following the methods of William Delbert Gann would have been patiently waiting as the evidence for a major turn began to align piece by piece. The time factor. The great post-war bull market had topped out on May 29, 1946. By June of 1949, the corrective bear market had been in effect for over 36 months, or 3 full years. This is a major time cycle. Furthermore, June 14, 1949, was the exact 1-year anniversary of the last major high, which occurred on June 14, 1948. The market was entering a critical time window based on multiple major cycles. The price level. The trader would have pre-calculated the major support levels. The high of the 1946 bull market was 213.36. A 25% decline from this high gives a major support level of 160.02. On June 14, 1949, the Dow Jones Industrial Averages made a final low of 160.62. The price had hit a major long-term percentage support level almost to the tick. Market structure. This was the 3rd time the market had tested this critical 160 support zone. The first low was in October 1946. At 160.49. The second was in May 1947 at 161.38. The formation of this massive triple bottom over a nearly 3-year period on the weekly and monthly charts was an overwhelmingly powerful sign of long-term accumulation and structural support. Confirmation by volume. The volume signature confirmed that the selling pressure was completely exhausted. The volume for the entire month of June 1949 was a mere 17,767,000 shares. This was a fraction of the volume seen at the 1946 top and indicated a market that was thoroughly sold out, with no significant supply left to push prices lower. The selling effort had vanished. The chart trigger. With time, price, structure, and volume all aligned, the trader waited for the final confirmation. After the June 14th low, the market began to rally. It soon put in 3 consecutive higher days, reversing the trend on the 3-day swing chart and crossing the last minor swing top. This was the mechanical trigger. This was the A-grade setup. Every single element of the Gann methodology had converged at the same point in time and price, all pointing to the same conclusion. A major bear market was over, and a new bull market was beginning. Finding high probability setups in the market is not a mystery, nor is it a matter of luck. As demonstrated by the life's work of William Delbert Gann, it is a methodical, scientific process of patiently waiting for a confluence of evidence. The secret is not in a single line on a chart or a single magic number. It is in the integration of all the key market dimensions. It begins with understanding the long-term market structure through weekly and monthly charts. It is refined by identifying the critical price levels derived from percentages and past highs and lows. It is activated by a mechanical chart trigger on the swing charts. It is confirmed by the force of volume. And it is given its ultimate probability of success when it aligns with the master factor of time. This disciplined, multi-layered approach is what separates professional scientific speculation from amateur guesswork. It is the framework that allows a trader to remove emotion and act with the cool confidence that comes from a decision based on an overwhelming weight of factual evidence. This is the core secret to the methodology of William Delbert Gann, and it is the only path to achieving his ultimate goal: to make speculation a profitable profession.